Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. Today, we're diving into Mapletree Industrial Trust's latest quarterly results, and let me tell you, there's some juicy stuff to unpack. MIT's been making waves in the industrial reit space, and their 3QFY 24-25 results show why they're worth keeping an eye on. Let's start with the headline numbers that got my scales tingling. MIT pulled in a net property income of $133.2 million. That's a solid 2.6% jump from last year. What's driving this growth? Their smart moves in Japan, particularly that new Tokyo acquisition and their Osaka data center, plus some really strong leasing activity across their portfolio. Wow, MIT's really crushing it this quarter. They've pumped up their net property income to $133.2 million. That's a sweet 2.6% jump from last year. You know what got them there? Their smart moves in Japan with that Tokyo purchase and their Osaka data center, plus they're killing it with their leasing game. Here's what gets my cold-blooded heart racing. They're sharing more with unit holders. We're looking at $97.1 million in distributions, up 2.0%, which means each unit gets 3.41 cents. That's 1.5% more than last year. Not too shabby. The Singapore portfolio is absolutely rocking it with a 9.8% rental reversion rate. That's like finding an extra juicy cricket when you're already full. And check this out. They've stretched their average lease expiry to 4.5 years, thanks to that sweet deal at their Richmond property. MIT just snagged a sweet freehold property in Tokyo for JPY 14.5 billion. As your favorite investing reptile, I love seeing this kind of strategic growth, especially in the hot data center market. They're playing it smart with their cash too, keeping $7.9 million from their distribution reinvestment plan. That's what I call thinking ahead. Let's dive into MIT's distribution track record, and oh boy, it's a beauty. What we're looking at is a fantastic visual of MIT's distribution journey since their IPO in 2010. The blue bars show the amount available for distribution to unit holders, left axis, while that snazzy orange line tracks the DPU in cents, right axis. And let me tell you, this trend is smoother than my scales after a fresh molt. The latest quarter shows distribution hitting $97.5 million with a DPU of 3.41 cents. But here's what really gets my investing senses tingling. Since IPO, the annual DPU has grown from 3.45 cents to a whopping 13.43 cents. That's what I call compound growth, folks. Notice how those blue bars keep climbing higher? Even through market cycles, MIT's been consistently growing its distributable income. There were some wobbles during the pandemic years around FY 2021, but look at that recovery. The trust bounced back stronger than a cricket on a hot sidewalk. This chart tells us something crucial. MIT is not just about short-term gains. They've built a track record of sustainable, growing returns over 14 plus years. That's exactly what we cold-blooded, long-term investors love to see. The steady upward trajectory in both distributions and DPU suggests robust underlying fundamentals and effective management strategies. Hot diggity! Gross revenue climbed 2.0% to $177.3 million, while net property income jumped 2.6% to $133.2 million. You know what's driving this growth? Our friends in Japan. That Osaka data center and the new Tokyo mixed-use facility are really pulling their weight. Plus, the Singapore and North American portfolios are showing some muscle with their new leases and renewals. Property operating expenses stayed practically flat at $44.1 million. Just a tiny 0.1% uptick. That's what I call tight cost control. Borrowing costs only increased by 0.3% to $26.1 million, which is pretty impressive in this high interest rate environment. Now here's where it gets interesting. Distribution to unit holders grew by 2.0% to $97.1 million, pushing the DPU up to 3.41 cents. That's a solid 1.5% increase. However, we did see a 15% drop in joint venture distributions, mainly due to some interest rate swap repricing. There's a small speed bump with the Tanglin Hall cluster divestment, causing some income loss, but MIT's managed to offset this with stronger performances elsewhere. The total number of units increased slightly by 0.5% to 2,848 million, showing disciplined capital management. What really gets my cold blood pumping is how MIT's maintaining growth despite some headwinds. They're offsetting property divestments with new acquisitions, managing costs effectively, and still delivering DPU growth. That's the kind of resilience we love to see. Looking at the total debt, we're seeing $3,173.0 million as of December 31st, 2024, which is a slight increase from September's $3,014.0 million. Now, before you get your tails in a twist, let me tell you why this isn't keeping me up at night. The aggregate leverage ratio is sitting at a comfortable 39.8%, giving them plenty of breathing room under the regulatory ceiling. Now, let's talk about their debt currency mix. It's like a well-balanced diet for your portfolio. The largest portion is in USD borrowings at 61.9%, followed by SGD at 20.3% and JPY at 17.8%. This mix perfectly supports their international portfolio, especially those juicy Japanese assets we discussed earlier. The weighted average debt tenor has shortened a bit to 3.1 years from 3.4 years, but here's what gets my cold blood pumping. They've maintained that sweet BBB plus rating with a stable outlook from Fitch. Plus, their loans are mostly unsecured with minimal covenants, giving them the flexibility to pounce on opportunities like a gecko on a tasty bug. They're also playing it smart with their distribution reinvestment plan. They've tucked away $7.9 million from the previous quarter's DRP with an impressive 8.5% take-up rate, and they're keeping this going for the current quarter. That's what I call efficient capital recycling. Looking at the next 12 months, we've got zero debt due in FY 24-25, which is fantastic news for our short-term stability. The debt is spread out really nicely over the next few years, with the biggest chunks coming in FY 25-26 and FY 26-27 at 24% each. This kind of staggered approach means we won't have to worry about refinancing everything at once. Super smart in this interest rate environment. What's really interesting is how they've mixed up their funding sources. We've got a combo of bank loans in yellow, MTNs, medium-term notes in blue, and even some joint venture loans shown in those dotted boxes. The largest single chunk we need to deal with is about $833.8 million in FY 26-27, but that's still manageable given MIT's strong credit rating we talked about earlier. I'm particularly impressed with how they've pushed some debt way out into the future. We can see small amounts stretching all the way to FY 38-39. That's some forward thinking right there. The weighted average tenor might be 3.1 years, but having these longer dated facilities gives them extra flexibility. First up, MIT is keeping a solid grip on their interest rate exposure with 78.3% of their total debt fixed. Sure, it's down slightly from 80.4% last quarter, but that's still a really comfortable level of protection against rate volatility. Their weighted average hedge tenor sits at 3.2 years, giving them a nice buffer against short-term rate fluctuations. The borrowing costs are looking pretty sweet too. Just 3.1% for the quarter, a tiny improvement from 3.2% in the previous quarter. Their interest coverage ratio is holding steady at 4.7 times, with an adjusted ICR of 4.3 times. These numbers tell us MIT's got plenty of breathing room to handle their debt obligations. Now, here's where it gets really interesting. Their sensitivity analysis shows they're well prepared for different scenarios. Even if base rates jump up by 100 basis points, we're only looking at a 1.5% impact on DPU. That's what I call resilience. And even in a stress test scenario with a 10% drop in EBITDA, their adjusted ICR would still be a healthy 3.9 times. What I really love about this is how it connects to their overall financial strategy. Remember those staggered debt maturities we talked about? combined with this robust hedging approach, it shows MIT's taking a really thoughtful approach to protecting unit holder returns. We're looking at MIT's impressive portfolio spread across 141 properties in 6 different segments. Let me tell you, these numbers are making my investing senses tingle. The portfolio's total assets under management stands at a whopping $9.2 billion, with a massive 25.2 million square feet of net leasable area. And get this, they're serving over 2,000 tenants. That's what I call a diverse tenant base that helps spread our risk nicely. Now let's talk about that beautiful pie chart. Data centers are the star of the show, making up 55.9% of AUM, with the majority in North America at 46.1%. This heavy data center exposure is exactly what we want to see in today's digital age. High-tech buildings come in second at 16.7%, followed by flatted factories at 15.3%. The rest is split between business park buildings, stack-up ramp-up buildings, and light industrial buildings. Looking at the geographical spread, Singapore still leads with 47.3% of AUM, followed closely by North America at 46.1%. Japan's piece of the pie is smaller at 6.6%, but remember that new Tokyo acquisition we talked about earlier. That's showing MIT's commitment to growing their presence in Japan. What really excites me about this portfolio mix is how it positions MIT for future growth. They're heavily invested in data centers and high-tech buildings. That's where the future is heading, folks. Plus, the geographical diversification gives us exposure to different market cycles and opportunities. What I love about MIT is how they've built their business on 3 solid pillars. Their portfolio stability is absolutely top-notch. They're not putting all their eggs in one basket. They've spread their risk across a huge tenant base, which means we don't need to lose sleep over any single tenant causing trouble. Plus, they're really focused on keeping their existing tenants happy, which explains those strong occupancy rates we've been seeing. On the financial front, they're playing it super smart. That 78.3% hedged borrowings we discussed earlier shows they're serious about protecting against interest rate surprises. They're also being clever with their capital management, keeping that $7.9 million from the DRP and planning to use the DRP for the next distribution shows they're thinking ahead about funding their growth. Speaking of growth, that Tokyo acquisition we talked about earlier wasn't just a random move. It's part of their bigger strategy to expand in key markets. Japan's data center and industrial markets are heating up, and MIT's positioning themselves right where the action is. So, what's the bottom line? MIT's showing all the right ingredients for long-term value creation, stable income from a quality portfolio, prudent financial management, and clear growth strategies. Their focus on data centers and international expansion gives them exposure to some exciting growth trends, while their strong balance sheet provides stability. For investors looking for a REIT that combines stability with growth potential, MIT definitely deserves a spot on your watch list. As always, remember to do your own research and consider how it fits into your overall portfolio strategy. That's all for today, folks. If you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell to stay updated on more investment insights. This is Iggy, signing off.